All right, so let's move on now to learning objective 3 of chapter 12, where we talk about goodwill. What is goodwill? How does it happen? How does it arise? Well, we only record goodwill when an entire, go away, and oh, Kevin, entire business is purchased. So one company gobbles up 100% of another company. Okay. Now, advanced accounting, which I teach in the summer, deals with this in great depth. So don't worry so much about all the different things that involve the purchase of another company. Just realize that when it comes to buying a business may have its own net assets. It's going to have its own assets minus liabilities. It's going to have its own equity, right? That's the book value of a company. We're going to have to revalue the company from a market perspective to figure out how much we want to pay to buy the business. And even when we do that, it's possible that the existing owners and shareholders, they want more money. And so when a company, after being valued, every little thing is being valued at fair market value, the business owners may still say, yeah, I still want more money. If we're willing to pay more money for the business, what do we call that? We will record all of its assets, its net assets, its assets and its liabilities on our books at their individual fair market value. But if we pay more beyond that, what do we call that? That's goodwill. And it only arises when we buy an entire another business. So this represents the future economic benefits arising from the net assets acquired in a business combination that are not individually identified nor separately recognized. In other words, all the assets and liabilities on a company's books that we buy, those are separate, those are identifiable. But if we pay more than that, that's what goodwill is. It's the stuff that is not individually identified. It's the excess. It's the leftovers, basically, from the business. Thank you so much for telling me that. So in this case, goodwill, the calculation of goodwill, in general, the definition that you want to pay close attention to is the excess of the purchase price of the company over the fair market value of the identifiable net assets. And we're going to go through some of those examples next. All right, so let's look at an example here. Go to the next tab. Recording goodwill, illustration number 1. So Beerbo decides that it needs a parts division to supplement its existing tractor distributorship. Beerbo is interested in buying Mineral Light, and Mineral Light's balance sheet is below. So this is the target. So sometimes if a company is buying another company, the way they kind of distinguish that is there is a target company, not target the company, but a target. We're shooting to buy another company, a smaller company, maybe a competitor. That's our target. Another way of looking at that is this is potentially a subsidiary. A subsidiary, whereas we as Beerbo might be called the parent. Okay, so if we're buying another company, one way to sort of distinguish it from a street language perspective is that's the target. How much is our target worth? In this situation here, our target, Mineral Light, has total assets $255,000. Total assets. Now that's from a book value perspective. That's what's in the company's books. Okay, that's in the ledger. It also has 55,000 in total liabilities. That's also the book value. Okay. So we can say that 200,000 is the net assets, or represents net assets of the company from a book value perspective. That's another way of saying, hey, look, 200,000, those are the net assets. Well, guess what? That also happens to be the sum of the overall equity, right? Assets minus liabilities equals equity. Hey, that's what net assets are. Net assets equal equity, okay? But this is the book value of the company. The book value of the net assets is the book value of the equity. We can say is the book value of the company overall. Now, the question that you want to ask yourself is Beerbo going to pay $200,000 for the company? Or more importantly, will Miller Lite likely ask for more than $200K? Of course they will, because they know that on a book value perspective, the book value doesn't represent the current market value of all the individual assets or liabilities. So here's what we do next. This is typically what happens when a small target company is about to sell itself to a bigger company. Usually there's some consultants that are hired, and sometimes they're called ABVs, or accredited business valuation specialists. Okay, so Beerbo, the parent company, hires consultants to determine the fair market values of Mineral Lite's underlying assets and liabilities. And in this case, when the consultants go in, they tear apart the target company, Mineral Lite. They look through every scrap of paper. They look at every asset. They barcode and scan everything. They evaluate every little crack in a desk, the processor speed of a computer, everything. That's what these consultants do. They're basically valuation specialists. Okay, so when it comes down to valuing all the individual assets in a sale, generally what you're going to see is the amount of cash in the checking accounts is going to be roughly the same fair value. So whatever the book value is, that's going to be fair value. Accounts receivable, in this case, let's just say it's $35,000. Now, if you recall from the previous chapter on when we factor receivables, we know that receivables, generally when they're sold or they're factored to somebody like GJ Wentworth, if GJ Wentworth buys receivables, GJ Wentworth's not going to pay dollar for dollar. GJ Wentworth is going to charge a financing fee, for instance, right? But in this case, it's a transferring of receivables from one business to the next. So if all the accounts receivable from the target company are carried over and to the parent company, Beerbo is going to pursue getting those accounts paid just as Miller Lite would. So it seems reasonable just to go ahead and say, hey, $35,000, that seems okay for the fair value of those receivables. Okay. Inventory, generally speaking, you see it go less than this example. But I'm going to say in this example that the inventory is valued at more. And I'm going to say the same thing for PP&E. It's being valued at a higher value. Generally, though, you see it going the opposite way. Patents, there's no patents on the books, but if we find out, which the story of this problem didn't share, but I would share this in the case of a homework problem or exam problem, if there's a patent that is not valued on the books or it's valued at zero, in this case, does the patent still have some value from a fair market perspective? Maybe we went ahead and amortized the patent over 10 years, but maybe there's still $18,000 of fair value in the patent. Fine, we'll record that as part of the fair value. Liabilities, $55,000 on the books. Let's just go ahead and say $55,000 is a fair value. How would liabilities be different? The only time you really see a liability differ from book value is when, say, you update, if it's in the case of bonds payable. If bonds are traded on an exchange, a bond exchange, generally the current trading price of those bonds is what's factored in determining what the overall liability is worth from a fair market perspective. When we add up all the fair market values, we figure out that the total fair market value of the net assets is $350,000. Okay? Which means, from an overall perspective, that Beerbo should potentially pay not $200,000 but $350,000, or should we say an extra $150,000 above book value? Where did that $150,000 come from? Well, you kind of see when you go across. Nothing. An extra $80,000 fair market value over the inventory, an extra $52,000 over and above the book value of the equipment, extra $18,000 for patents. That's where that's coming from in this case. So part of the analysis during negotiation time, hey, 350 is a fair value. Here's where the extra value is coming from, these particular assets. And there can be some argument back and forth as to whether or not these figures are reasonable. So now the question is, will Mineral Light ask for more than the 350K? I bet it will, because here we're just simply saying all that's well and good. Those are fair market values when you break it down on an asset by asset basis. But Mineral Light doesn't have to accept that as the offer. They can say they want more money. And in fact, that's what we're going to look at next. In this final scenario, Beerbo accepts an offer of $400,000 for Mineral Light's net assets. So the stockholders of Mineral Light come together and say, we'll sell all of our shares, 100% of our shares, not for $350, but for $400. So down below, is the fair value still $350? No. It's actually more like $400,000. That's the fair value, not of the net assets, but really of the company overall. The fair value of Mineral Light, when you factor in this other $50,000, is $400,000. Well, what is that $50,000? Why are we paying an extra? Why is Beerbo paying an extra $50,000? Well, we call that goodwill. Goodwill, which doesn't appear anywhere in the assets of Mineral Light, is the $50,000 that we pay above the net assets, the fair market value of the net assets. So we're paying an extra $50,000 on top, and we're saying that basically the book value of $200,000, another $200,000 is being added on top of that to account for the fair market value adjustments of the net assets, as well as a kicker of goodwill. So why pay an extra $50K? Okay. Well, we don't have a whole lot of power when it comes to another company's possessions. We have to negotiate. We have to make them happy. But we also have to be happy as well. We don't want this to be a hostile takeover. Okay? So if we sprinkle an extra $50,000 on top of the deal, right? What are we really creating with that extra $50,000? We're creating goodwill between Beerbo and Mineral Light. In other words, we are not just worried about gobbling up another company. We have to worry about its people. The people, meaning the employees, the shareholders, the vendors, suppliers, customers, etc. These are the people we have to keep in mind when we're undergoing one of these purchases. It may very well be the case that we have to fire, if we're Beerbo, we may have to fire some, shall we say, redundant employee functions. So if we already have a robust accounting group, do we need to also hire or bring on board the accounting group from Mineral Light? No, we have our own. Perhaps we need to lay them off. Well, that's going to cause some bad blood. We don't want that. So let's kick in an extra $50,000 to the shareholders and let them figure out how they're going to divvy it up. And maybe they provide some type of compensation package or severance package to the people that are likely to be laid off. Because once we acquire all of the assets and liabilities, it doesn't mean we acquire the people. That's going to be part of a separate negotiation altogether. So keep that in mind when it comes to buying a business. We have to worry about the people just as much as we worry about the assets, the net assets. Now let's look at how we're going to account for this thing. So keep in mind that the fair market value, what we're talking about here is we got a fair market value of Mineral Light's net assets, right? And we've got goodwill. Right? The sum of those is going to be the purchase price of Mineral Light. Okay? Now, some things to keep in mind about that, right? We are going to record, or what I like to call onboard, or transfer. We're going to transfer the individual assets and liabilities of Miller Lite into the books, into Beerbo's books. In other words, Miller Lite's cash is now Beerbo's cash. Miller Lite's accounts receivable are now Beerbo's accounts receivable. Okay, so down below, the amount that we're going to record is not the book value. We're not transferring the book value of these things. We're transferring the fair market value. What did our consultant say was the value of cash? Cash on a fair market basis was $25,000. Accounts receivable, fair market value, $35,000. Inventory, we paid $122,000 for Miller Lite's inventory. Even though Miller Lite has a book value of $42,000, when we bought Miller Lite, essentially what we did was we paid $122,000 for Miller Lite's inventory. Doesn't matter what their book value is. We only care about fair value. It doesn't matter what Miller Lite's property, plant, and equipment was at a cost basis. We're concerned about the fair value. So Miller Lite's net book value is, this is kind of confusing here. Beerbo's new cost basis is the fair market value. So in this case, we're going to say 205. That's the fair market value of Miller Lite's property, plant, and equipment that we onboarded. Patents were not on Miller Lite's balance sheet. Therefore, the book value on Miller Lite is 0, but we record the fair value, $18,000. And let me skip down to current liabilities. The fair value of the current liabilities was $55,000. We ended up paying cash from Beerbo, $400,000, which means that what's the plug figure we need here? The plug, it's got to be the $50,000, which we call goodwill. So everything except for goodwill was already on the books at Miller Lite. It was just recorded on Miller Lite's books as book value. We're bringing it on our books at fair market value. The goodwill did not exist anywhere before this transaction. Goodwill is created as a result of this transaction. Isn't that strange? $50,000 of value didn't exist until everybody signed the bottom line, the dotted line. Once the transaction was complete, poof, there is an asset now of $50,000. Only in the real world, it's more like $50 million or maybe $5 billion in goodwill. Happens just like that. You created an asset. It's a long-term asset. Now you have to figure out how to record this thing on a regular basis. More importantly, how do you deal with all the amortization, if there is any? Before I move on to the impairment analysis of goodwill, I want to go through another example here. So this is illustration number 2, in which case Beerbo purchases Dudmeiser Inc. for $300,000. Dud's net assets are analyzed below. So in this case, I give you the straight up information. I say book value 15, 10, 50, 80, accounts payable 25, fair values all assessed in the middle column, and the excesses over book value on the far right. Now down below, you can see that while the fair value of the net assets totals to 200,000, the true fair value of the company as a whole is 300,000, which means there is an extra $100,000 of value added on top of the fair market value of the individual assets. Why was $100,000 sprinkled on top? Well, to create goodwill. Create goodwill between the company and everybody else. There's nothing on the books with regard to that, so the overall amount we see here, an extra $100,000. And that creates, Beerbo is paying $170,000 above book value for the company. Why? Some of it was due to excess fair value over book value, and the rest was just poof, created out of thin air called goodwill. It's an asset now. We have to record it on Beerbo's books. So again, the $100,000 in this case, $100,000 buys goodwill, good feelings between Beerbo's employees, shareholders, etc., and in this case, Dead Miser's employees, shareholders. That's why we pay extra. So that's how you determine how goodwill arises. Is it possible that we actually pay less than the fair market value of the net assets? Yes, and that's going to result in a gain in bargain purchase. I don't want you to worry about that, because generally speaking, those sort of situations arise very seldomly, where we actually pay less than the fair market value of the net assets. And those are usually for companies that are in distress. Okay? Let's not worry about that. Let's just focus on paying more above the fair market value of the net assets.